The AI bubble is close to bursting. This isn't a prediction whispered in the shadowy corners of a Reddit forum, nor is it the bitter grumbling of a Luddite who just lost a chess game to their smart toaster. No, this is a conclusion drawn from a series of increasingly loud and flashing warning signs that are becoming impossible to ignore. The words AI will change everything have been echoing through every boardroom, every news broadcast, and every venture capital pitch meeting for what feels like an eternity. The money flowing behind those words is even louder. A deafening cascade of billions poured into startups promising to revolutionize existence itself, often before they've even figured out how to pay their own electricity bill. This relentless, feverish optimism has created an atmosphere of pure, unadulterated financial delirium. We have arrived at a spectacular precipice, a moment shimmering with both unprecedented promise and terrifying peril. On one side, we see headlines heralding the dawn of a new technological epoch, a future where artificial intelligence cures diseases, solves climate change, and maybe, just maybe, finally figures out why socks disappear in the laundry. On the other side, however, the ground is starting to feel suspiciously soft. The frantic race to own a piece of the AI pie has inflated expectations to a point that defies gravity, logic, and basic accounting principles. It's a gold rush, where the gold might just be lines of code that hallucinate facts, and the mines are energy-guzzling server farms that could boil a small ocean. The air is thick with the scent of irrational exuberance, a term coined decades ago for just such a moment as this. Big tech firms, once the untouchable titans of the market, are now in a frantic arms race, shoveling capital into their AI divisions, as if their very survival depends on it, and perhaps it does. Investors, gripped by a severe case of FOMO, are throwing money at any company with AI in its domain name, creating a market where potential is valued far more than present-day profit. But history has a nasty habit of repeating itself, and the patterns we are witnessing today bear an unsettling resemblance to financial bubbles of the past that ended not with a gentle hiss, but with a catastrophic bang that left portfolios in ruins and careers in tatters. The signs are all there, if you're willing to look past the dazzling light of the hype machine. The sky-high valuations, the growing number of layoffs, even within successful AI teams, the technological bottlenecks that no one wants to talk about at cocktail parties. These are not minor tremors. These are the deep, foundational groans of a structure under immense strain. The frenetic pace of investment cannot be sustained forever, especially when the promised revolutionary breakthroughs are slower to materialize than the breathless press releases would have you believe. The party has been loud and long, but the music is starting to slow down, and soon the lights will come on, revealing exactly who has been building real value and who has just been dancing on a table made of vapor. Before we dive deeper into the silicon-fueled frenzy, let's take a moment to define our terms. What exactly is an economic bubble? Imagine you're at a bizarre auction for a single, perfectly ordinary tulip. A bubble is when prices are driven by speculative belief, not fundamentals. It begins with a compelling news story, creating a feedback loop where rising prices and media hype fuel a fear of missing out. The first symptom of the AI bubble: mind-boggling valuations. Companies with little more than a pitch deck are handed billion-dollar valuations, betting on a distant, hypothetical profit. But when reality returns, the pop is inevitable, and the aftermath is never pretty. The second pillar supporting this precarious bubble is the relentless, deafening hype cycle. Breathless news stories, sensationalist advertisements, bold pronouncements from CEOs. We are told that AI will eliminate disease, end poverty, usher in an age of unimaginable abundance. Simultaneously, we are warned that it will take all our jobs, subvert democracy, potentially lead to our extinction. This schizophrenic narrative swings between utopia and dystopia. Its purpose: keep AI at the forefront and create urgent momentum. Hype cloud's sober judgment encourages rash decisions in boardrooms and personal accounts. The hype has real financial consequences. It pressures companies to promise the impossible. CEOs claim AGI next year, set expectations that cannot be met, leading to disappointment. Overpromising leads to half-baked products prone to errors and hallucinations. Early AI search engines gave confidently wrong answers. Image generators botched basic things, like fingers. Failures erode public trust. The third unstable pillar, the hardware bottleneck. AI runs on a specific, expensive, limited resource, high-end GPUs, mostly made by one company, NVIDIA. Training a large model can need tens of thousands of chips costing hundreds of millions and using electricity for a small city. To understand where we might be heading, we need only to look back a quarter century to the year 2000. The parallels between the current AI boom and the dot-com bubble are as striking as they are unsettling. In the late 1990s, the mantra was not, AI will change everything, but the internet will change everything. A revolutionary technology had captured the public imagination, and investors, terrified of being left behind indiscriminately, threw money at any company with .com in its name. Companies like Pets.com, Webvan.com achieved massive valuations based on the promise despite having business models that, in hindsight, were fundamentally flawed and hemorrhaging cash. The narrative was intoxicating. The new economy was here, and old metrics like profitability and revenue were considered relics. All that mattered was eyeballs, mindshare, first-mover advantage. Analysts predicted exponential growth, and the stock market rewarded this optimism with soaring prices. It was a time of legendary excess, lavish launch parties, Super Bowl ads for companies that had never turned a profit. Anyone who urged caution was dismissed as a dinosaur who just didn't get it. This is the exact same rhetoric we hear today from the most fervent AI evangelists who wave away concerns about profitability and resource costs as short-sighted thinking. Then in March of 2000, the bubble burst. It wasn't a single event, but a rapid loss of confidence that cascaded through the market. The Nasdaq index, heavily weighted with tech stocks, lost nearly 80% of its value over the next 2 years. The companies that were once the darlings of Wall Street went bankrupt in spectacular fashion. Pets.com, which had raised $82.5 million in an IPO, liquidated just 9 months later. The fallout was immense, wiping out an estimated $5 trillion in market value and leading to widespread job losses and a brief recession. The landscape was littered with the wreckage of companies that had burned through billions with nothing to show for it. However, the bursting of the dot-com bubble was not the end of the internet. Far from it. The crash was a brutal but necessary correction. It cleared away the froth, the hype, unsustainable business models. The companies that survived the carnage, firms like Amazon, eBay, were the ones that had been quietly building real businesses with real customers and a focus on long-term value. The bust also made a vast pool of talented engineers and developers available who went on to build the next generation of web companies like Google, Facebook. This history lesson is crucial. A bubble bursting doesn't destroy the underlying technology. It merely destroys the inflated expectations surrounding it, paving the way for a more sustainable and ultimately more productive phase of growth. So, here we stand, on the precipice of what looks increasingly like a major market correction for the AI industry. Stratospheric valuations, unsustainable hype, rising layoffs, technical bottlenecks, eerie historical parallels. This does not mean that AI is a fraud or that its potential was a mirage. The technology is genuinely transformative. The burst, when it comes, will not be an extinction-level event for artificial intelligence itself. Rather, it will be a painful but cleansing forest fire that burns away the undergrowth of speculation and allows stronger, more resilient entities to thrive. The survivors will be the companies that focused on solving real problems for real customers, not those that focused on raising the next funding round. For those caught in the storm, the consequences will be real. Investors who gambled on speculative startups will see their portfolios evaporate. Talented employees at over-leveraged companies will face job losses and uncertainty. Public trust in AI, already fragile, may take a significant hit as the media narrative shifts from breathless optimism to cynical postmortems. There will be a period of pain and disillusionment, a winter for AI where funding dries up and progress seems to stall. But this winter will not last forever. It will be a time for sober reflection, for rebuilding on a foundation of reality rather than fantasy. The strong companies with viable products and prudent financial management will not only survive, but will emerge with less competition and a clearer path forward. So, what is the path forward? How can one navigate this treacherous landscape? The advice is simple, though perhaps not easy to follow in a world screaming for you to do the opposite. First, for investors, exercise extreme caution. Question the hype. Demand to see evidence of a viable business model, actual revenue, and a sustainable cost structure. Diversify your investments and resist the urge to bet the farm on the next guaranteed unicorn. Second, for those working in the industry, focus on building durable skills. Engineering, product design, and a deep understanding of safety and ethics will be valuable long after the hype fades. Focus on building products that provide tangible, defensible value. And finally, for everyone, as consumers, citizens, and leaders, we must approach this technology with a healthy dose of skepticism. We need to demand transparency, accountability, and a focus on human well-being from the companies building these powerful tools. The future of AI doesn't have to be a boom and bust cycle. It can be a story of steady, responsible innovation. A bursting bubble can be a moment of destructive chaos, but it can also be a moment of clarification, a chance to reset our expectations and proceed with greater wisdom. Therefore, the final message is not one of despair, but one of caution. In the relentless gold rush for artificial intelligence, remember that the most valuable commodity is not hype, but prudence.